My dear students, welcome back to our channel. In this video, I will be explaining the Bcom third semester subject Advanced Accounting as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 1 first important short question is: what do you mean by partnership? A partnership means an agreement between two or more persons who come together to run a business and share its profits and losses. It is created by an agreement, which can be written or oral, called the partnership deed. Each person involved is called a partner, and together they are known as a firm. The business name under which they work is called the firm name. The main idea of partnership is teamwork and shared responsibility. All partners combine their money, skills, and efforts to run the business. Example: suppose Ramesh and Suresh start a small textile business together. Ramesh invests 1 lakh rupees and Suresh invests 50,000 rupees. They agree to share profits and losses in the ratio of 2:1. This is called a partnership firm. In short, a partnership is a simple and flexible form of business that runs on trust, cooperation, and shared goals among partners. Next important short question is: to define partnership deed. A partnership deed is a written agreement that contains all the rules and terms agreed upon by the partners while starting a partnership firm. It helps to avoid misunderstandings or disputes among partners in the future. This deed usually includes details like name of the firm, nature of business, capital contributed by each partner, profit-sharing ratio, duties and powers of partners, interest on capital or drawings, and rules for admission or retirement of a partner. Example: suppose Ravi, Kiran, and Mahesh start a furniture business. They write down all details such as profit-sharing ratio 3:1 and capital contribution in a document and sign it. This document is their partnership deed. In short, a partnership deed is like the constitution of a partnership firm, which keeps everything clear and fair among partners and serves as a guide whenever doubts or conflicts arise. Next important short question is: 3. Explain fixed capital and fluctuating capital account. In a partnership firm, each partner has a capital account showing how much money they have invested in the business. There are two methods of maintaining these accounts: fixed capital method and fluctuating capital method. 1. Fixed capital account. Here, the capital of each partner remains constant. Any change like interest, drawings, or profit is recorded in a separate account called the current account. Example: if A and B invest 1 lakh rupees and 80,000 rupees respectively, their capital balances stay the same every year unless new capital is added or withdrawn permanently. 2. Fluctuating capital account. Here, all adjustments, interest, drawings, profit, etc., are made directly in the capital account. So, the balance keeps changing every year. Easy tip: remember, fixed is equal to stable capital, fluctuating is equal to changing capital. Most small firms prefer the fluctuating method because it's simple and easy to maintain. Next, Unit 1. Long questions. First important long question is: define partnership. State its features. Explain different types of partners. A partnership means an agreement between two or more persons to run a business jointly and share profits and losses in an agreed ratio. It is based on mutual trust, cooperation, and combined effort. The law relating to partnership is given under the Indian Partnership Act, 1932. Definition: as per Section 4 of the Indian Partnership Act, 1932. Partnership is the relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. Features of partnership. 1. Agreement. Partnership is formed by a written or oral agreement among partners. 2. Number of partners, minimum 2 and maximum 50, as per Companies Act, 2013. 3. Profit sharing. Partners share profits and losses as per the agreement. 4. Lawful business. Partnership must be for a legal business only. 5. Mutual agency. Every partner acts as both principal and agent of the firm. 6. Unlimited liability. Partners' personal assets can be used to pay firm's debts. 7. No separate legal entity. Firm and partners are treated as the same in law. Types of partners. 1. Active partner. Takes part in daily business operations and shares profits and losses. Example, Ravi manages the shop daily. He is an active partner. 2. Sleeping, silent partner. Invests money but does not take part in day-to-day work. Example, Ramesh invests capital but stays away from business activities. 3. Nominal partner. Lends his name and reputation to the firm but does not invest money. 4. Partner in profits only. Shares only the profits, not the losses of the firm. 5. Minor partner. A minor cannot form a partnership but can be admitted to benefits of partnership with consent of all partners. In short, a partnership is a team effort where partners bring in money, skill, and trust to run a business together and share the rewards and risks jointly. Next important long question is: to explain the methods for preparation of capital accounts in partnership. In a partnership firm, each partner invests some amount of money, called capital, to start and run the business. The record of this investment and all related changes, like profits, drawings, interest, etc., is shown in the capital account. There are two main methods for preparing partners' capital accounts. 1. Fixed capital method. 2. Fluctuating capital method. 1. Fixed capital method. Under this method, each partner's capital balance remains constant year after year. All adjustments such as interest on capital, drawings, profit or loss are recorded in a separate account called the current account. So, each partner will have two accounts. Capital account, fixed amount. Current account, for yearly adjustments. Example: A and B start a firm with 1 lakh rupees and 80,000 rupees respectively. At the end of the year, A earns 5,000 rupee interest and withdraws 2,000 rupees. These are recorded in A's current account, not in the capital account. Hence, the capital balance remains unchanged. Easy tip: think of fixed capital as a locked box. It doesn't open for small changes. 2. Fluctuating capital method. Here, only one account is maintained for each partner, the capital account. All items such as interest on capital, drawings, salary, share of profit or loss are recorded directly in this account. As a result, the capital balance keeps changing, fluctuating every year. Example: if C and D invest 50,000 rupees and 40,000 rupees respectively, and C earns 5,000 rupee profit and withdraws 2,000 rupees, both items are recorded in C's capital account itself. So, the closing balance changes every year. Easy tip: remember, fluctuating is equal to flexible because the capital moves up or down with business results. Conclusion: method No of accounts capital changes. Example: fixed 2, capital plus current, no large firms. Fluctuating 1, capital only, yes, small firms. Both methods show the partner's investment clearly, but fixed capital offers more stability, while fluctuating capital is simple and easy to maintain. Next important long question is 3. Explain the fixed and fluctuating capital methods with suitable examples. In a partnership firm, each partner contributes money, capital, to start the business. The record of this money and its changes is kept in the capital account. There are two methods of maintaining these accounts. 1. Fixed capital method. 2. Fluctuating capital method. 1. Fixed capital method. Under this method, the capital of each partner remains constant throughout the years. Any adjustments such as interest on capital, drawings, salary, commission, and share of profit or loss are not shown in the capital account. Instead, these are recorded in a separate account called the current account. Thus, each partner has two accounts. Capital account shows fixed investment. Current account shows yearly changes. Example: A and B started a partnership with 1 lakh rupees and 80,000 rupees respectively. During the year, A earned 5,000 rupees as interest on capital and withdrew 2,000 rupees. Under the fixed method, these two items are recorded in A's current account, while the capital account remains 1 lakh rupees. Tip to remember: fixed means unchanged, like money kept in a locker. 2. Fluctuating capital method. Under this method, only one account is maintained for each partner, the capital account. All adjustments such as interest, salary, drawings, profit or loss are recorded directly in the capital account. Hence, the capital keeps increasing or decreasing every year. Example: X and Y started a firm with 60,000 rupees and 40,000 rupees respectively. X earned 10,000 rupee profit and withdrew 5,000 rupees during the year. Both transactions are entered in X's capital account, so his balance becomes 65,000 rupees. Tip to remember: fluctuating means changing, just like a wave that rises and falls. Main difference: basis fixed capital, fluctuating capital. No of accounts 2, capital plus current 1, capital only. Capital balance remains constant, keeps changing. Suitable for large firms, small firms. In short, fixed capital is equal to stable and fluctuating capital is equal to flexible. Both help show the partner's financial position clearly. Next important problem is 4. X, Y, Z were partners sharing profits in the ratio of 4:3:3 respectively. Their balance sheet as on 31st December 2020 was as under. Y retire on the above date on the following terms. A. The goodwill of the firm is to be valued at 7,000 rupees. B. Stock and buildings are to be appreciated by 10%. C. Plant and motor car are to be depreciated by 10%, 53,000. D. Liability for the payment of gratuity to workers, 2,000 rupees is not yet recorded in books, but the same is to be provided for. E. Provision for bad debts is no more necessary. F. It is decided not to maintain goodwill account in the books. G. The amount payable to Y is to be paid in 3 equal installments beginning from 1st January 2021 with interest at 10%. P. You are required to prepare revaluation account, partners' capital accounts and balance sheet of X and Z after Y retirement. Let's do this step by step and keep it simple. I'll show the revaluation account, then partners' capital accounts, showing how goodwill and reserve are distributed, and finally the balance sheet of X and Z after Y's retirement. I'll explain each step in an easy-to-remember way. Step 0. Starting figures, as given. Capitals, X 16,000 rupees, Y 12,000 rupees, Z 10,000 rupees, total 38,000 rupees. Reserve, 5,000 rupees, bills payable 2,000 rupees, creditors 8,000 rupees. Assets, buildings 18,000 rupees, plant 14,000 rupees, motor car 4,000 rupees, stock 10,000 rupees, debtors 7,000 rupees less Prov. 1,000 rupees net 6,000 rupees, bank 1,000 rupees. Totals is equal to 53,000 rupees. Profit sharing, old ratio, is equal to X, Y, Z is equal to 433. Step 1. Revaluation adjustments, make a quit list. A. Goodwill of firm is equal to 7,000 rupees, handled later, not kept as a separate goodwill AC. B. Stock 10% is equal to plus 1, 000, 10,000 rupees times 10%. C. Buildings 10% is equal to plus 1, 800, 18,000 rupees times 10%. D. Plant 10% is equal to 1, 400, 14,000 rupees times 10%. E. Motor car 10% is equal to 400, 4,000 rupees times 10%. F. Provide for gratuity, new liability, is equal to 2,000 expense. G. Provision for bad debts is no more necessary, reverse provision is equal to plus 1,000. Now total increases is equal to 1,000 rupees plus 1,800 rupees plus 1,000 rupees is equal to 3,800 rupees. Total decreases is equal to 1,400 rupees plus 400 rupees plus 2,000 rupees is equal to 3,800 rupees. Net revaluation profit loss is equal to 3,800 rupees. 3,800 rupees is equal to 0 rupees. So revaluation does not change partners' capital's overall neat. Remember, count all plus items on credit side and items on debit side of revaluation AC. Here both sides equal, revaluation AC is balanced, nil profit. Step 2. Transfer of reserve. Reserve 5,000 rupees is distributed to partners in old profit ratio 4:3:3. X gets is equal to 4/10, X 5,000 is equal to 2,000 rupees. Y gets is equal to 3/10, X 5,000 is equal to 1,500 rupees. Z gets is equal to 1,500 rupees. So reserve becomes nil in the books. Step 3. Goodwill treatment, not maintained in books. Firm goodwill is equal to 7,000 rupees. Y's share is equal to 3/10, X 7,000 is equal to 2,100 rupees. Since Y is retiring, the remaining partners X and Z must compensate Y for his goodwill share in the ratio they will continue to share profits. Assuming X and Z continue in their old proportions of 4:3, their shares of Y's goodwill are: X base is equal to 4, 4 plus 3, X 2,100 is equal to 4/7, X 2,100 is equal to 1,200 rupees. Z base is equal to 3/7, X 2,100 is equal to 900 rupees. Effect on capital accounts. Excess capital is debited 1,200 rupees, he pays, Z's capital is debited 900 rupees, and Y's capital is credited 2,100 rupees, receives goodwill amount. We do not open goodwill AC, amounts adjusted directly in partners' capitals. Step 4. Prepare partners' capital accounts, working. Start with opening capitals, then post reserve and goodwill adjustments. Opening capitals. X is equal to 16,000. Y is equal to 12,000. Z is equal to 10,000. Add reserve share. X plus 2000 18,000. Y plus 1,500 13,500. Z plus 1,500 11,500. Goodwill adjustment, pay receive. X pays 1,200 rupees 18,000 1,200 is equal to 16,800 rupees, final. Z pays 900 rupees 11,500 900 is equal to 10,600 rupees, final. Y receives 2,100 rupees 13,500 plus 2,100 is equal to 15,600 rupees, amount due to Y. Revaluation gave net nil, no change. So final capital balances, immediately after adjustments. X is equal to 16,800 rupees. Z is equal to 10,600 rupees. Y is equal to 15,600 rupees. This Y balance is what the firm owes Y on retirement. Step 5. Payment terms for Y and presentation in books. Y is to be paid in 3 equal installments starting 1st January 2021 with interest 10% PA. Since no payment is made on 31st December 2020, we transfer Y's capital balance to a liability called amount due to Y, payable in 3 installments, for presentation in the balance sheet. So the firm will show a liability of 15,600 rupees, principal, as amount due to Y. Interest will be charged and accounted for when installments are paid, from 1st January 2021 onwards. For the balance sheet as at 31st December 2020 we show this 15,600 rupees under liabilities. Step 6. Prepare revaluation account, capital accounts, summary tables and balance sheet. Revaluation account, extract. Dr. Revaluation ACCR, Revaluation AC. To plant depreciation 1,400 by stock appreciation 1,000. To motor car depreciation 400 by buildings appreciation 1,800. To gratuity provision 2,000 by provision for bad debts 1,000. No net gain or loss. Total 3,800 total 3,800. Net effect is equal to nil. Partners' capital accounts, after adjustments. Capitals, X, Y, Z. Opening capital 16,000, 12,000, 10,000. Add, reserve share 2,000, 1,500, 1,500. Less, goodwill paid to retiring, 1,200, 900. Add, goodwill credited to Y, 2,100. Final capital balance 16,800 15,600 10,600. Y's 15,600 rupee will be shown as amount payable to Y in 3 installments with interest under liabilities. Balance sheet of X and Z after Y's retirement as at 31st December 2020. Liabilities. Capitals. Excess capital AC is equal to 16,800 rupees. ZS capital AC is equal to 10,600 rupees. Bills payable is equal to 2,000 rupees. Creditors is equal to 8,000 rupees. Gratuity provision, new liability, is equal to 2,000 rupees. Amount due to Y, payable in 3 equal installments with 10% PA interest, is equal to 15,600 rupees. Total liabilities is equal to 16,800 plus 10,600 plus 2,000 plus 8,000 plus 2,000 plus 15,600 is equal to 55,000 rupees. Assets. Buildings, 18,000 plus 10% is equal to 19,800 rupees. Plant, 14,000 10% is equal to 12,600 rupees. Motor car, 4,000 10% is equal to 3,600 rupees. Stock, 10,000 plus 10% is equal to 11,000 rupees. Debtors, original 7,000, provision of 1,000 reversed net 7,000 rupees. Bank is equal to 1,000 rupees. Total assets is equal to 19,800 plus 12,600 plus 3,600 plus 11,000 plus 7,000 plus 1,000 is equal to 55,000 rupees. Assets is equal to liabilities balanced. Final quick checklist, memory aids. Revaluation net is equal to 0, no profit loss distribution. Reserve 5,000 rupees distributed in old ratio 4:3:3. Y's goodwill share 2,100 rupees paid by X and Z in ratio 4:3 X 1,200 rupees, Z 900 rupees. Y's total due is equal to capital 12,000 plus reserve 1,500 plus goodwill 2,100 is equal to 15,600 rupees, to be paid in 3 equal installments with 10% PA interest. New capitals, X 16,800 rupees, Z 10,600 rupees. Next important problem is 5. The following is the balance sheet of X and Y as on 31st March 2020. Z was admitted as partner on that date when position of X, Y was as under. X, Y agreed share profit in proportion of 3:2. The following terms of admission are agreed upon. 1. Revaluation of assets, land and buildings 18,000 rupees, stock 16,000 rupees. 2. The liability on workmen's compensation fund is determined at 2,000 rupees. 3. Z brought in as his share of goodwill 10,000 rupees in cash. 4. Z was to bring further cash as would make his capital equal to 20% of the combined capitals of X and Y partners after above revaluation and adjustments are carried out. 5. The future profit sharing ratio of X, Y and Z was as under. X is equal to 2/5, Y is equal to 2/5, Z is equal to 1/5. Prepare revaluation account, capital account and balance sheet after ZS admission. Admission of Z step-by-step solution, simple, clear. Given, as on 31st March 2020. Old partners X and Y share profits 3:2. Balance sheet totals 50,000 rupees. Step 1. Revaluation of assets and liabilities. Adjust as per terms. Land and buildings, 8,000 rupees, 18,000 rupees, increase 10,000 rupees. Stock, 12,000 rupees, 16,000 rupees, increase 4,000 rupees. Workmen's compensation fund liability, 4,000 rupees, 2,000 rupees decrease 2,000 rupees. This reduction is a gain for partners. Total revaluation gain is equal to 10,000 rupees plus 4,000 rupees plus 2,000 rupees is equal to 16,000 rupees. This gain is distributed to old partners in the old profit ratio 3:2. X is equal to 3/5 X times 16,000 is equal to 9,600 rupees. Y is equal to 2/5 X 16,000 is equal to 6,400 rupees. So revaluation AC is credited 16,000 rupees and debited to the assets liability adjustments, net effect 16,000 rupees profit. Step 2. Goodwill brought by Z. Z brings 10,000 rupees as goodwill in cash. For admission, goodwill is distributed to old partners in the sacrificing ratio. Old ratio X, Y is equal to 3:2. New ratio given is equal to X, Y, Z is equal to 2/5, 2/5, 1/5. Compute sacrifice is equal to old new, for old partners only. X, 3/5, 2/5 is equal to 1/5. Y, 2/5, 2 divided by 5 equals 0. So sacrificing ratio x, y is equal to 1 o'clock. X gets the full 10,000 rupee goodwill, y gets 0 rupees. Effect: credit excess capital by 10,000 rupees and cash increases by 10,000 rupees. Step 3. ZS capital to be fixed at 20% of combined capitals of X and Y after adjustments. We must find X and Y capitals after revaluation gain and goodwill adjustment. Start with opening capitals. X is equal to 10,000 rupees. Y is equal to 8,000 rupees. Add revaluation shares. X plus 9, 619,600 rupees. Y plus 6, 414,400 rupees. Add goodwill credit from Z is 10,000 rupees. X plus 29,600 rupees. Y unchanged 14,400 rupees. Combined capitals of X and Y is equal to 29,600 plus 14,400 is equal to 44,000 rupees. ZS required capital is equal to 20% of 44,000 is equal to 8,800 rupees. Z already brought 10,000 rupees for goodwill. Goodwill is not counted as capital unless specified. So Z must now bring 8,800 rupees as capital in addition to 10,000 rupee goodwill cash. Step 4. Prepare revaluation AC. Format and numbers. Revaluation account. DR. CR. 2. No decreases other than shown by land and buildings AC 10,000. 2. If any decreases by stock AC 4,000. By workmen's comp. Fund 2,000. Net gain transferred to partners. Total DR. Total CR 16,000. Net revaluation profit is equal to 16,000 rupees distributed to X and Y in 3 as 9,600 rupees and 6,400 rupees. Step 5. Capitals after admission. Summary table. Opening capitals and adjustments. Partner opening capital plus revaluation share plus goodwill share plus capital introduced by Z. Final capital. X 10,000 rupees plus 9, 600 plus 10, 000, 29,600 rupees. Y 8,000 rupees plus 6, 400 plus 0, 14,400 rupees. Z brought 10,000 rupee goodwill plus 8, 800 capital brought 8,800 rupees. Note: 10,000 rupee cash from Z, goodwill, is in cash assets, 8,800 rupees is ZS capital. Step 6. New balance sheet after admission, as at 31st March 2020. Assets. Cash and bank, opening 9,000 rupees plus ZS goodwill 10,000 rupees plus ZS capital 8,800 rupees is equal to 27,800 rupees. Stock, revalued, is equal to 16,000 rupees. Plant and machinery is equal to 10,000 rupees. Land and buildings, revalued, is equal to 18,000 rupees. Debtors is equal to 11,000 rupees. Total assets is equal to 27,800 plus 16,000 plus 10,000 plus 18,000 plus 11,000 is equal to 82,800 rupees. Liabilities and capitals. Workmen's compensation fund, redetermined, is equal to 2,000 rupees. General reserve is equal to 16,000 rupees. Creditors is equal to 12,000 rupees. Capital accounts. X is equal to 29,600 rupees. Y is equal to 14,400 rupees. Z is equal to 8,800 rupees. Total liabilities and capitals is equal to 2000 plus 16,000 plus 12,000 plus 29,600 plus 14,400 plus 8,800 is equal to 82,800 rupees. Assets is equal to liabilities balanced. Short memory tips for exam. Revaluation gain distribute in old ratio. Incoming goodwill distribute to old partners in sacrificing ratio old new. When incoming partner must bring capital equal to A% of combined old capitals, compute combined capitals after revaluation and goodwill adjustments to old partners, then take that percentage. Goodwill cash is usually treated separately, credited to old partners, not counted as incoming capital unless stated.